Welcome to another episode of Uncommon Entrepreneurs Lunch and Learns. I'm here today with Jack Krupey. Buddy, we go back maybe a good year or so, and we're both down here in the Puerto Rico ecosystem and have had just backgrounds both in real estate, which has connected us. And so we're going to kind of be getting into this Lunch and Learn series. We have another one on Friday. We do these Wednesdays and Fridays. You can watch the replay if you didn't catch this live, or other ones where we'll highlight successful entrepreneurs in the community that are making pivots and making moves happen. We're all going through a very difficult time right now with the uncertainty of how the world is playing out, right? And so it's so critical at this moment to slow down and listen to experts and professionals in different areas of industry to get ideas of how they see and formulate and go about it. And what I think is really going to pique your interest today about Jack's experiences, he lived through the 2008 bubble in the distressed mortgage and other real estate realms on the residential side, which we'll get into, and that unique perspective, he can see trends and ideas of how that connects. As well as kind of like hidden opportunities right now that are available and kind of just in general real estate trends in Puerto Rico as well as the U.S. So just to give you a little bit of background on who Jack is and let him share his knowledge. Jack is a seasoned real estate and distressed debt investor. He spent the last 10 years focusing on residential non-performing mortgage market, where he was the founder of a firm that was acquired by a large a private equity fund and completed more than $3 billion worth of whole loan purchases in that time. Jack relocated to Puerto Rico a couple years ago and officially left his firm in March of 2019, where he has since joined Kellogg Global Executive MBA program in partnership with the Hong Kong University of Science and Technology, where he spent most of 2019 traveling between Puerto Rico and Hong Kong, two different islands, which we'll get into and their similarities. And Jack's new firm, JK Asset Management, is an Act 20 company which invests and consults in alternative asset space, including distressed loans, real estate, as well as participating in various real estate syndications, including multifamily and self-storage, as well as limited partnerships and general partnerships. How you doing today, Jack?
Doing great. Thanks for having me.
Yeah, you're welcome. So we're gonna kind of get into it. Let's fill in the blanks on your story with, maybe starting, with how you got into real estate and leading to Puerto Rico.
Sure. So I actually have a degree that I've never really used in information technology. I graduated in 2001 during the dot-com bust. So, I thought I was going to go kind of heavy into computers and internet stuff. And then all of a sudden the job market wasn't so great in information technology. Yeah. I actually went to Las Vegas for my 21st birthday and saw kind of the glitz and the glamour, and was playing $5 hand blackjack next to a guy playing like $100 hand blackjack. And I sort of looked at what I was doing wasn't going to make me the kind of money and lifestyle that I wanted. Yep. And I bought a book at Hudson News for my flight home, How to Make $1 Million in Real Estate. Okay. It was one of those like $15 paperback books you'd see at the store. And I got back to Rochester, where I'd finished college and was still living, and asked my landlord about real estate. And he was sort of a local real estate hustler, owned about 20 properties and was renting to college students. Nice. And within 30 days, I'd bought a house with almost no money down. It was a relatively, Rochester's still a relatively inexpensive market compared to New York or California. So it was a two-family house for just under $60,000, and it rented for $1,100 a month. Nice. Good cap rate. Yeah, it was a great cap rate. And so what was happening is people from New York and California were going to Rochester to buy cash flowing properties. So I bought one, and then a few months later bought another one, and within a year and a half I had 10 properties, and I did have an IT job that I ended up quitting within a year, and had my rental properties and started wholesaling and flipping houses, and I ended up getting my real estate license just to have access to the multiple listing service system and just to have the deal flow. So did that between 2002 and 2007 when the world started to collapse ahead of the financial crisis, and we saw it coming a little earlier because it was harder and harder to get loans done on investment properties at the time. And I was from New Jersey. I'm from New Jersey. Okay. Always wanted to move closer to New York City. So when things froze up in Rochester, I still had a few properties. I'd moved more to flipping than just purely holding rental properties. I sort of got burnt out with dealing with the tenants and toilets, which sort of foreshadowed moving more into the debt side and less into the being a landlord side.
Got it.
So I moved to New York City in the beginning of 2008 and ended up at a small private equity fund that was buying non-performing loans.
Okay.
So I started there in November of 2008. The bleeding edge of the financial crisis. And at the time, that firm was buying non-performing second mortgages, basically home equity lines of credit at in some cases 3 cents on the dollar.
Got it.
Again, this was a time everyone was worried about catching the falling knife. Property values were underwater. And really, it was uncharted territory. Historically, real estate had rarely dropped, especially nationwide. So there was tons of fear in the market, and those second mortgages, there was a good expectation that a majority of them could have been worthless at the time. It turned out that was, the one trade that if I had hindsight, I would have been more aggressive on was buying more of those at the time. But was at that firm for about a year and a half, and was involved in both the loss mitigation and the asset management of those loans. We were taking in calls from investors and the borrowers to try to work out payment plans or short sales or modifications. So, and we were not about trying to get to people's houses. And even to this day, any of these mortgage investments that I do, either on my own or with partners, we would much rather modify a loan and work out a repayment plan with the homeowner than take the property. But unfortunately, in some cases, there's no choice. Especially in some of these loans that were originated in 2007 and 2008. Some of the people should have never gotten the loan and lied about their income on their paperwork because you could write down whatever number. Exactly. So long story short, even though it's already a long story, I left there in 2010 and started my own firm, just buying small portfolios of non-performing loans and focused more on the first mortgage side just because it was easier to raise money, honestly. There's a lot of real estate investors understood the first mortgage side, but the second mortgage side was so risky that just people weren't as comfortable. And I was buying 5-10 loans a month, and then it scaled up. And then in 2014, we partnered with a private equity fund that wanted to move into the investment space for buying mortgages. And it grew from a $5 million science experiment to purchasing over $3 billion of loan portfolios by the end of 2019.
Wow!
And it was an amazing ride, but I'm a more entrepreneurial person, and sort of got burnt out with the New York City lifestyle and the New York City taxes and cost of living, and wanted to make a change and sort of have a better quality of life. So I moved down here in the end of 2018
to Puerto Rico. Where we're filming right now.
Yeah. So I've been down here since the end of 2018, but I traveled so much in 2019 that this year was the year I really feel like it's home.
I felt like you were on a plane like every other week. We would chat.
I think I flew 275,000 miles in 2019.
Wow.
And I earned a fair amount of miles, but I was burning a lot of frequent flyer miles too for some of the trips.
And what was that for? What was most of the travel?
So most of it was for the Kellogg Executive MBA program. I was looking at local programs. Being sort of this entrepreneurial real estate guy, I didn't really have some of the finance pedigree that a lot of the people I was working with in New York had. So I wanted a bit of an adventure. I wanted to round out my skills, and the network through Kellogg's is incredible as well. So and from listening to some of the other Puerto Rico opinion leaders, like the Sovereign Man is here, like Peter Schiff, there was a little bit of sort of concern about the U.S. dollar, and there's a certain part of me who just wanted to have an international experience and just have more international connections for long-term future. So that's really why I chose to do the program that was in partnership with Hong Kong, and met a ton of interesting executives from all over the world. Our class had 63 MBA candidates from 19 different countries.
Wow.
There's only 5 Americans in the program. There was people from Singapore, from mainland China, Hong Kong, Indonesia, Vietnam, a number of European expats, many of which were working in Hong Kong or Singapore for many years, and it was really an amazing experience. And there was a number of partner schools. So there's Kellogg has partner programs in mainland China, in Israel, in Germany, and then there's 2 campuses in the U.S. So all told, met with probably 500 plus executives from all over the world, and made a number of lifelong business connections and friendships, and it was worth the jet lag.
Yeah. And so you're kind of winding that down from what I gather?
Yeah, I'm actually finished at this point. Graduation was supposed to be in June in Hong Kong, but that's not happening at this point.
Yeah.
It may happen. It may happen in December if travel restrictions are lessened.
Yeah. Interesting. Okay. Have you flew to Hong Kong during the last few months while everything's been happening?
So I was in Hong Kong in January. And we were supposed to go back in February for our last on-site class, and Hong Kong was already starting to have some coronavirus cases. So they actually moved those classes online. However, they were going to be online in the Hong Kong time zone, so I would have had to stay up all night for the classes. So I actually flew to Singapore. Just because I have a number of my friends from class are actually based in Singapore. So I actually went to Singapore instead and hung out with some of my classmates, and we did the classes through online, but in a conference room.
Got it.
And while I was there, the first case of coronavirus happened in Singapore, coincidentally at the hotel that I was staying at. It's been well more than 14 days, so don't worry. But I'm dodging coronavirus. Obviously there was a lot of protests in Hong Kong.
Yeah.
There was protests in Puerto Rico while I was in Hong Kong in July, and I barely missed the volcano that erupted in the Philippines because I was actually visiting one of my classmates in the Philippines, and I was on the plane and they canceled the flight because the volcano had erupted in Manila, south of Manila at the time. So lots of excitement this year, maybe a little too much excitement.
Yeah, exactly. Interesting. Yeah. So how would you compare Hong Kong, Puerto Rico? Any similarities or?
I'd probably compare Hong Kong more to New York and New York or San Francisco. I mean, it's such a finance capital.
Yeah.
It's a hard place to describe because you can be in Central and you feel like you're in London or New York, and you could be on the Kowloon side. So Hong Kong has Hong Kong Island, and it has Kowloon, which is attached to the mainland, but is still part of the District of Hong Kong. And you could be at the Temple Street night market in Kowloon and feel like you're in mainland China with stalls, and not quite a wet market, but just very you wouldn't realize you're 5 minutes away from the financial district of Hong Kong. So it's a very, very diverse melting pot of Asia.
Yeah. Interesting. Okay. So maybe how's Puerto Rico for you? What kind of had brought you here? How have you kind of found the network? Kind of what's that to you?
Sure. So it's been great for me so far. And again, even though I've been here a year and a half, I feel like I'm really still getting started.
Yeah.
I knew a few people that moved down in 2016, 2017, so I was aware of the community down here. I think I joined one of the Facebook groups in 2017 and was just trying to learn about the different neighborhoods and figure things out before I got down here. And ultimately, it ended up a pretty quick decision to actually pull the trigger and move down here. Towards the end of 2018, I had a friend that was moving and ended up just deciding to get a 2-bedroom apartment with him and jump on the lease so that I could actually have a home base down here before the end of 2018. So was down here, and one of the things I really like about it is the network that it's been relatively easy to build so far. You have so many people that are I don't want to say starting over, but kind of building a new life down here, and open to making new contacts, making friends, doing business networking, and that's been great. I mean, when you're close to 40, well, actually I'll be 41 on Sunday, living in New York, and it's it's people kind of have their networks, and then people start having kids and moving to the suburbs, and it gets harder to kind of make new contacts. And it's one of the amazing things here is you have hundreds of like-minded entrepreneurs that have made this decision to move to this island, and you're surrounded by interesting people that have interesting businesses, and it's to some extent that same sense of adventure. It's one thing to have the means and the ability to move down there. It's another thing to actually have that sense of adventure to do it.
Yeah, valid point. Yeah, exactly. On that front, interesting. So maybe pivoting to the point you were making earlier. It's interesting. You were involved in 2018 or 2008, 2019. You saw that market. We're in this very uncertain time with businesses shut down. There's a major difference between what's potentially going to happen with the residential and the commercial side of real estate. Let's talk about how you see that transition in the residential side. How does it compare? Where do you see it going? Kind of that. Let's start down that line of thinking.
Sure. So I'm actually more bullish on the residential real estate market. I know some of my friends and colleagues were worried about a 2008 type collapse in the residential market, and I don't see that for the residential space. I think one of the key reasons is I don't think there'll be the same level of supply.
Got it.
In 2008, you had a number of years of mortgages where many of the people should never have gotten the loans. You could have a stated income, stated asset loan, and essentially, one of the jokes was if you could fog a mirror, you could get a mortgage. And there was a glut of inventory of people who just walked away once the prices stopped appreciating. So the underwriting standards, while they've loosened a bit from the bottoms in 2009 and 10 to now, there's still much stricter underwriting standards. The ability to repay needs to be demonstrated. So first point is the underwriting standards were not as poor. I think the second point is just by nature of this coronavirus, people that don't have to sell are less likely to actually list their property. They're not going to want various strangers walking through, and you can say all you want about virtual showings, and I think that may help with vacant properties and to maybe screen some out, but ultimately people are going to need to get a majority of people are going to need to get into houses to make decisions. So I think many homeowners that were thinking of selling but don't have to may just wait this out. And the other key point is lenders are much more conditioned both to modify loans. It's been forced into their process over the last 5 or 10 years to have an efficient process to work with homeowners, to do forbearance agreements, to do loan modifications. And the federal GS government servicing entities, Fannie Mae, Freddie Mac, have all been very clear that they are pushing their servicers to do everything they can to give people that are affected by this crisis forbearances, modifications, and then the private mortgage market. Because what tends to happen is a lot of these loans are owned by these large government agencies, and then they'll sell in some cases $500 million to $1 billion portfolios to large investment banks, large private equity funds that will then own these loans privately. They're no longer government owned. And at that point, they'll trickle down to smaller opportunistic investment funds and mortgage funds that will service the loans. So across the board, a majority of those groups want to modify the loans because they're buying them at a discount.
Got it.
If you have a $200,000 house where the balance is roughly $200,000, let's say there's really not much equity. In many cases, those loans are being sold for 70%, 65% of the balance and of the current value of the property. So the investors are buying at a reasonable discount. So if they can get that homeowner to start making those payments again, it's generally close to a double-digit return, and those are good returns. Now, after 12 months of payments, in many cases, you could then sell that loan as a reperforming loan back to a bank. and actually sell the loan at closer to par. So you could essentially flip the loan without ever having to take possession of the property. And that's why I can still do this business, albeit at a much smaller scale than when I was, in New York. But I could do this business from Puerto Rico. I very rarely, in the 30,000 loans that we oversaw in New York, I probably was inside less than 10 houses in 10 years. And it was only the really intriguing cases. We had a $1.5 million property in Colts Neck, New Jersey, less than an hour away. So drove to that one just to make sure we knew what we were getting into, because it was a large rehab. But it's a very virtual business.
Interesting.
And one of the other, just on the investment side, one of the other things that's been really, I would have never thought it before I got into the business is the level of support to be able to work virtually.
Got it.
Because there's so many vendors, between realtors, between property preservation teams that will rekey and secure a vacant property. I can essentially get interior photos of any vacant house in the country within 48 hours. So whether the property's in Texas, in Georgia, Montana, it really doesn't matter. I can get eyes in the property very quickly and manage to liquidate a foreclosure in anywhere in the country.
Interesting. Okay. Yeah. And so how would somebody that is intrigued by this idea maybe invest or go down that path?
Sure. So it's definitely not an efficient market. There's no one multiple listing service or exchange for buying these private mortgages. So there's a number of advisory firms, brokers at various levels.
Sure.
If you're buying $50 million, you can go to investment banks, and some of the major, almost all the major investment bank desks have trading desks, but they're not going to talk to you if you don't have $50 million. And it goes down to, there's a number of small brokers that will sell 1-2 loans at a time, and there's probably 100 or so funds that operate at that small scale, where they have between $1 million and $5 to $10 million, and they'll buy from some of the larger groups and they'll sell to some of the smaller groups on a more geographic basis. Got it. There's a number of buyers who only want Texas or only want in their backyard, and then there's other opportunistic buyers who really will buy anywhere if the numbers work. Sure. So it's really just a smattering of Facebook groups, LinkedIn groups. You have to kind of weed through some what I call joker brokers. Yeah. The guy with an AOL.com email address who's trying to broker a $50 million pool of loans is probably not legitimate. He's probably forwarding a tape hoping to get lucky, but there are a number of legitimate sources to find opportunities, and it's a great angle for real estate investors that are a little tired of dealing with the tenants in the toilets and want a more passive way to invest, and also able to buy at discounts. Sure. It's pretty competitive in the even at the courthouse steps still. Even with COVID, the Florida market, the New Jersey market is still very active. New Jersey, the last stats I have, is actually up. I think some of it is a little bit of people trying to get out of the New York City metro area and more of a suburban locale. Sure. And I don't know if that's going to sustain for the coming months or years, or if that's just sort of a quick knee-jerk reaction to the crisis. But it's a business that's really why I feel not that I'm still bullish on the residential market. Is with that said, there's certain areas that are going to have some pain. Yeah. I'd certainly be careful with my personal money investing in Las Vegas today. Yeah. Orlando.
Depending on the market.
Exactly. It's market by market, but I'm not expecting a wholesale 30% drop in real estate prices across the board. I think certain markets are going to have appreciation or be very stable. Other markets may have that 20% correction if they're dependent on tourism or oil or something that has a regional shock. Got it.
Yeah. So a big factor is the appraisal value, the loan to value of the property, and as some people are tight on cash right now, and maybe that's a cause for them needing to go through foreclosure in your neighborhood, which could draw the price down of the whole neighborhood. How do you see that, the lack of, income and working, and do you see, how does that play out in the residential market?
Sure. I mean, it undoubtedly will have some level of effect. I think that scenario that you're describing is going to be cushioned by the fact that that person who does have financial distress is going to have months and months to work out a forbearance agreement, to get a loan modification. So if those jobs just completely disappear and there's not a V-shaped recovery, and it takes 2 years and that specific homeowner just hasn't been able to find a replacement source of income, sure, there's unfortunately going to be some foreclosures or just distressed sales, but it's not going to be overnight.
Okay.
And in 2008, you had hundreds of those people who, in some cases, didn't really have income and were just getting loans to rent out with negative cash flow, just with the dream of selling the property for more money. So, I think in general that time will cushion a lot of those scenarios. Whereas even if a few percent of those people ultimately don't get back on their feet, if they owned a restaurant and that restaurant failed, there's going to be a drop, but it's not going to be as significant. There's also a lot of investors with dry powder.
Got it.
There's a number of REO to rental funds that their whole business is to buy single family houses and rent them out. You had Blackstone and Colony Capital all buying 30,000 houses in various markets like Atlanta and Las Vegas. And that industry didn't really exist at an institutional level before the 2008 crisis. So it provides a bit of a floor. If housing prices drop 10%, 15% in the market, the houses are going to eventually approach a cap rate where institutions will buy them and hold them in their portfolios and rent them out for a number of years until the market stabilizes. So that's another factor that I think will keep the residential market, relatively stable.
Got it.
In the scheme of things.
Yeah, so tighter lending requirements, Dodd-Frank Act, less foreclosures as a result, more time for people to recover. It's going to take a couple years before that type of an impact. Is that kind of what I'm hearing you say?
Yeah.
It's more, there's time. This isn't 2008 when they were handing out a bunch of loans to people, so interesting. That makes sense. So, switching to, we're in Puerto Rico. How do you see the real estate market down here?
Sure. Well, I mean, Puerto Rico has been in a recession for a number of years, unfortunately. So, I think it's who knows if it's I think if we're not at the bottom or weren't already at the bottom, I think we have to be somewhat close. I mean, there are some concerning statistics about the population continuing to decline. I think I saw some headline about another few 100,000 people may move in the next year or two, but there is a lot of opportunity. Both in the the condado and Sinterse and the higher end areas, as well as just throughout Puerto Rico. There's I think a huge need for workforce housing, affordable housing to just standard middle class housing in this market. And I think there's a ton of opportunities for those that are coming down here with some capital to both buy investment properties, to rent, to renovate. Almost the entire island outside of Dorado and parts of Condado is an opportunity zone.
Yeah, let's hit on that. So most of the island, around 98% is in the opportunity zone. Maybe clarify what that is briefly, and then what's the opportunity you see there?
Sure. So, and there's been full webinars on this topic, so I'll touch on it. And I'll give my 30-second pitch, and I encourage people to look for more. You could see a whole half-hour presentation on it. But the short answer is it's a zone designated that allows you to both defer a current capital gain that you have that doesn't even need to be from real estate. You could sell a stock portfolio and have a $200,000 capital gain, but if you buy a property in an opportunity zone and do enough renovation to it to qualify, then your gain will be deferred until 2026. So if you were going to have to write a check to the IRS for $100,000 and instead you buy a property, renovate a property in Puerto Rico, or invest in a fund that does that on your behalf. So you don't need to do the dirty work yourself. You could invest in an opportunity zone fund, and you won't have to pay that tax until 2026. And it also has a step up in your basis. So your $100,000 tax bill may end up only an $80,000 tax bill in 2026. The other key benefit is if that project is held for 10 years and it appreciates in value, when the ultimate project sells, there's no capital gains on that sale.
Got it.
So it's very powerful, both the deferral and really the long-term avoidance of capital gains. The only other way to do that previously was through a 1031 exchange, where you could only shelter a real estate capital gain with trading up to another higher valued real estate property, and it was certainly doable, but it took a lot of coordination. You needed to identify a property within, I believe, 90 days, and you had a 6-month window to do the transaction. So if something happened, if the seller backs out, or if you lose your financing, there was a lot of things that could happen that could put your entire deal at risk.
Got it.
So I think there's a lot of opportunities on the island, both on a small scale, even just renovating a house, to investing in a larger opportunity zone fund.
Sure.
One of my friends here on the island is looking at there's a hotel credit.
Yeah, tell us about that.
Yeah, and I think it's we'll have to update. It's either Act 14 or Act 7. Do you know the exact?
Not off the top of my head.
Yeah, I may have confused them, but yeah, there's a specific act for hotel hospitality that will actually give you a dollar for dollar tax credit on your renovations, and also shields majority of your future income. Is taxed at a preferential rate once the property is complete. And it doesn't need to be a large hotel. It could be a 3-unit bed and breakfast or Airbnb. It doesn't need to be a large scale project. So I know the one project that I know is active that I'm looking into now. If you buy the property cash, do the renovation, and then do a refinance, and at like a 70 loan to value, just a reasonable refinance. That refinance, along with the tax credits against your rehab budget, will pull a majority of your cash out of the deal.
Wow.
So on a $500,000 investment with a $500,000 rehab, you may have $1 million in, and then refinance at 80%, plus get maybe 10% back from the construction budget. And again, this is not one of my key areas of expertise. So I feel I'm just
more of an idea. Explaining the opportunity. And
so I'd certainly consult. I would consult the tax professionals before you write a check for these things. And I know some people maybe on a follow-up webinar. I know a few people that are much more familiar with that. That tax grant that could probably give a better explanation to your.
So in this same kind of line of thinking, we were talking yesterday about kind of the investment lending and hard money side. Where do you see opportunities on lending side down here?
Sure. Well, there's definitely a shortage of investment type loans that are either called hard money or to some extent non-QM lending. But there's to my knowledge very few what I'd call fix and flip or hard money lenders that are providing short-term financing for investment projects. I did a Google search, and I was searching in English, but maybe there's more. But from the people I've talked to that are real estate professionals, there's just not that many private sources of capital that would lend money for renovating properties short-term on the island. So I think personally, as a way to make money and give back to improve the island, I think it's a great opportunity for investors to be short-term private lenders. You can make double-digit returns at reasonable loan to values, because there's a lot of people on the island that have enough cash to do one project, but with the right partnership and leverage might be able to do 2 or 3. There is still solid demand over all parts of the island for housing, both potentially for Airbnb, which is probably on a bit of a holding pattern for the moment, and also just standard workforce housing and just the average middle class housing on the island. So there's no shortage of properties that that need updating and renovation. And I think part of the issue that's causing this is the lack of credit available. So I think there's properties that are sitting vacant that, but with the right financing, they'd probably already be renovated. But the cash to acquire them as is, where a bank won't touch a property that's as is and vacant, and to be able to get it to the point where it can be sold to an owner occupant or leased as office space. So it's a huge need, and
which would improve the whole neighborhood if the lending was available.
Absolutely. And there's opportunities. There's a lot of wholesale opportunities around. There was a portfolio of REOs that was just being marketed that I know a few other people in the Act 20 community were acquiring. So that's I believe like roughly 120 properties that are going to be turned in the next 3 to 6 months and renovated, and turn them from foreclosures into occupiable buildings. So I think that's a great thing for the island and a great way to make make income. And stateside, the same opportunities are there. I'm actually I did a small deal this morning in Jersey City where I own a partial interest in a loan, and it's a 14% return for a 6-unit building in Jersey City at a very conservative loan to value with a investor who's done multiple projects, and they're going to pay a 14% interest rate for the next 12 months just because there's a need for capital, because the major banks have sort of backed off into a what I'd call a risk off environment right now until they figure out how the market is going to stabilize. So look, is it riskier now than a couple months ago? Maybe, but frankly, at the loan to value of the deal, I almost feel less risky because it's post the COVID reset. So I'm in at a conservative number where I feel like the scariest time has hopefully already passed.
Yeah, interesting. And so lenders restricting their financing is causing that, if I'm hearing what you're saying.
Yeah, that's definitely a key cause here.
Yeah.
And that'll take some time. I think to some extent, some lenders might have been getting a little too aggressive, and certain investors might have been getting a little too aggressive.
Yeah.
There was certainly a chase for yield. Mm-hmm. The fix and flip market, in the middle of February, you could, there were fix and flip loans being originated at 7.5%, 8%. Which would have been unheard of 10 years ago. I mean, the fix and flip market was almost always a double-digit return market. People charging 10%, 12% interest rates. So there was such a demand for any sort of yield with the Fed rate at less than 2 at the time, and then since going to 0, that just too many firms were bidding down the price of assets, even assets that, in the scheme of things, were certainly a fix and flip loan is more risky than a 30-year fixed on a single family house. But the yields, there was just a lot of aggressive groups. For the investors that are still standing, that have dry powder, it's a great time, just because the yields are really where they should be. It's a solid risk return, and I think if you do reasonable underwriting and you're at a conservative loan to value, I'd much rather be investing now than 3 months ago, stretching to compete with 10 people for one deal.
Yeah. So with the Fed rates, going down, how do you see that playing out, like in the economy at large?
I mean, it's a great time to get a 30-year loan if you can get it. Rates are close to as low as they can get. The mortgage rates, I don't see the mortgage rates going to 0. They're still going to mark up the Fed's rate. I think I looked online, and I think actually the rates in Puerto Rico are potentially cheaper than the mainland right now. I think I saw 2.5% for, and then this is for an owner-occupant mortgage. But yeah, I think if you can, lock in long-term financing at this point, it's an amazing opportunity. That's one of the reasons that, again, that was one of the other things you mentioned in the bio was the multifamily and the storage. Those are the asset classes I'm still bullish on. I'm not even going to touch retail. It's not my area of expertise. I think it's going to be probably a dumpster fire for a while. But the multifamily goes back to what I was saying on the single family houses, is that people are still going to need a place to live, and if the supply is under control on the investment side, on the single family house side, there's still going to be a demand for apartment living, and similar to my point of the time being right, there was a huge demand and competition to buy apartment complexes, and people were bidding them to lower and lower cap rates. And now that we've passed COVID, you could buy a better cap rate and a slight discount to where you would have bought a few months ago, and certain buyers are on the sidelines. And with that said, you have to make more conservative assumptions. We're not looking at deals and assuming that we're going to have 5% rental increases every year. But being able to buy a project at a lower price post-COVID with more conservative assumptions that still work out to a solid return on investment, is a great opportunity. And I keep having one of the classes we took at Kellogg was value investing. And the professor had studied at Columbia under Ben Graham, who was Warren Buffett's mentor, and he went through just a number of statistics on dollar cost averaging into the market. Whereas if you invested all of your money right before the 1929 crash, it would have taken 11 years to get your money back. However, if you had dollar cost averaged over the course of 6 months, whether it's 6 months before to 6 months after or 3 months before, you would have actually recovered within 1.5 to 4 years in some cases, depending on when you started. So I look at those principles for all of the real estate investing as well, as to be looking for good opportunities that you're underwriting to be getting a good deal you're comfortable with in the current market conditions. And over the course of the next year or two, I plan to continue to deploy capital and find interesting opportunities that make sense post-COVID. And even if things correct more than I think, if there's higher unemployment or asset prices drop even more over the course of the next 2 years, eventually we'll be close to the bottom. And if the bottom's further than that, then we're all in trouble.
Good point. You have to go through that with a conservative lens. So kind of wrapping things up, I know we hit on it earlier, the power of networking down here. I know one of your goals is similar to mine, and connecting investors together and bringing people kind of in the community together with kind of ideas, and feel free to kind of explain what you were saying your intentions are.
Sure. So I've been here a year and a half, but I feel like because of all the travel, this is the first time I'm really here consistently. And I love to network and learn and meet other like-minded entrepreneurs. So I don't even have a website up yet because my non-compete ended a few months ago, and frankly I'm really looking. It's more of a lifestyle business at this point. I'm not looking to build a large company with hundreds of employees. I'm looking to focus on what I enjoy doing, which is talking investments and looking for interesting opportunities. So, I'm looking to network and catch up and have coffees, lunches, beers with as many like-minded investors as possible. Given the sort of probably a limit on large groups. One of the things that I know, you and I have talked about, and also, my friend Nate, who's also an active real estate investor on Island, we talked about doing maybe small group, kind of 8 people lunch and learns, whatever the maximum we're allowed to do. So, I'd encourage everyone to reach out, to me on LinkedIn, the Facebook group, WhatsApp. I will put my contact details in the show notes, and definitely reach out with any questions or opportunities, and hopefully we can coordinate some events as we're allowed to do events, and catch up more formally.
Sounds great. We'll make sure to put the link in details below, so you'll be seeing it there. So kind of signing off. Appreciate you coming on. I think a lot, if you were paying attention, a lot of value in what you just dropped from your perspectives and, you know, traveling from Hong Kong, being down here, from Puerto Rico, from New York, from your time in Rochester with the distressed mortgage. It's all kind of coming together where it's the catalyst right now. So yeah, so if you like this, like, share, subscribe. We'll be doing more interviews. We have another one Friday that you're not going to want to miss with a top consultant, Linda, and some other ones coming in the preceding weeks that'll be fascinating. Tell us type of topics and themes and questions that you have, and if you have more questions for Jack, you know, put them in the notes. We'll make sure to get those answered and reach out to him with questions. So yeah, appreciate you coming on.
Absolutely. Thanks for having me.
Yeah, you're welcome. Yeah.